Macquarie Group shocked the market with a 25% cut in half-year profit forecasts. At one point, its shares sank to a 15-month low, and despite a rally, they were still down nearly 5% at the end of the day. Investors were also concerned that projections for the rest of the year were based on a major upturn in business. Some analysts say Macquarie's world changed with the onset of the financial crisis, and there will be no quick return to business as usual. Here's Emily Stewart.
Operating conditions for investment banks have worsened in the past 6 months, and some analysts are predicting the days of huge returns and high pay in the millionaire's factory are over.
One of the most significant issues Macquarie is facing at the moment is the high cost-to-income ratio it has, which basically means it has too many people and is paying them too much. It's actually going to lead to lower staff numbers and lower pay per head for Macquarie over the next year or so.
Things have gotten a lot worse. If you were to go back to their result announcement, which was right at the end of April, at that time they said they expected all 5 divisions to beat last year. And then what's happened is, as these very disadvantageous environment has continued, they've kept on flagging that things aren't getting any better. So this is the 3rd profit warning we have seen.
During a presentation to an investment conference in London, Managing Director Richard Shepherd said since the company's AGM in July, conditions in most markets have continued to be weak, adversely impacting business activity levels. The group's profit for the first half of the 2011 financial year to September is expected to be around $360 million, 25% less than the same time the previous year. The full-year profit is predicted to be in line with last financial year, as long as market conditions recover to a more normal level in the second half of the year. The worst-hit business areas include the trading and advisory businesses that account for nearly 3/4 of the group's revenue.
But I suspect the really big killer is that what we're seeing in markets at the moment is that everything is becoming more correlated, which means the opportunity to make trading profits is much reduced. And this is not a Macquarie-specific phenomenon. This is something we're seeing around the world for all investment banks.
And with a slowdown in activity in equity markets and merger and acquisitions, analysts are concerned about future revenue-raising opportunities.
The Macquarie model has changed forever. The Macquarie model is now more a capital-intensive, lower ROE, lower return on equity business than it has been for many years.
Investors have been rattled by the announcement, with Macquarie shares falling as much as 8% to $34, a 15-month low. Stocks closed at $35.25, down almost 5%.
And Macquarie Bank is a long way off the highs, but what this is really telling you is that the market is basically pushing out the trajectory of when they think the earnings will rebound.
And analysts predict shares are likely to go down further.
Over the next 6 months, we're likely to see another 10% fall, unless market activity picks up significantly, which would largely be reflected in an increase in equity markets of some significance.
Brett Lemaitre says profits in the year ahead are likely to pull back to the lower level the group experienced in the 2009 financial year.